Bank of Australia surprised markets at their last meeting in June with a 25 basis rate hike. Citing strong labour and inflation data, the RBA needed to act to keep inflation under control and drag it down from its 6.6% year-on-year core reading and 7% year-on-year headline reading, well above the 2% target. Furthermore, on the 15th of June, the Australian labour market is showing that it's very, very strong. Headline coming in well above the 15,000 forecast and above market's maximum expectations. So a surprise 75.9 thousand increase in jobs being added to Australia's economy. And on top of that, you can see that the majority of those jobs were full-time and unemployment rate staying at those historically low levels and the participation rate high as well. Very strong labour market, that's inflationary. So does this mean that the RBA has more hikes to come? Now in the UK, the situation for the Bank of England is slightly different. Yes, inflation in the UK is high at 6.8% year on year for the core. However, the Bank of England will risk stifling growth if it has to hike rates aggressively from here. Now that's potentially a pound negative. So just watch out here, the pound, it's up at that monthly 200 exponential moving average. Will we find sellers here in the pound Australian dollar pair? High UK inflation here could actually result in the pound losing value if traders fear a stagflationary environment in the UK, and that would be pound negative. So just watch out for potential pound Australian dollar losses here. Now, we do have a number of risks coming up, and there are a number of risks to this outlook. So the major risk, of course, would be if inflation rapidly cools in the UK or in Australia. Labour and inflation data will be crucially important for both the RBA and the BoE, and a major risk to policy outlook. And also the Bank of England meet this week. So that's an upcoming event risk for Thursday. So there's a lot of moving parts here. And if you look at the bond yield spread, this is quite interesting. This is the UK 10-year bond yield spread minus the Australian 10-year bond yield. So that spread there, you see it moving higher. Typically, you'd expect prices to keep tracking higher. It hasn't been tracking higher. That's potentially a little indication that maybe a little bit of distress. So just watch out for further signs of distress in this bond yield. Usually you see price tracks the bond yield very closely. And when it doesn't track the price so closely with the UK gilts, that can be a sign of distress. Do see the link in the text for a explanation of this to the Times Radio in the UK.